Being good with money is more than just meeting your instant requirements. The essential thing in money handling is investing it wisely so that your hard-earned money can work for you. Savings schemes are one such investment method offered by the Government of India, banks, or financial institutions to support you in handling your money. This video will give you an overview of various savings schemes available for Indian citizens and their importance. What are savings schemes? Savings schemes help individuals save a part of their income for future use. The government, financial institutions, or banks decide on the interest rates for these schemes, which are periodically updated. The returns from these schemes can be used to meet financial requirements during emergencies, higher education, marriage, job loss, debt repayment, down payment for loans, retirement and more. Savings schemes come with a lock-in period, hence they are considered ideal for long-term investment options. These are one of the safest investment options as they are not impacted by market volatility. Savings schemes in India. There are plenty of savings schemes available in India. A few of these are offered by the Government of India, while RBI and SEBI regulate a few. Some of these schemes provide income tax exemptions and deductions as well. Read about each savings scheme in detail below. 1. Employees Provident Fund. The EPF was launched by the Employees Provident Fund Organization, EPFO, to help the employees save money for retirement. An organization with over 20 employees must contribute to the EPF scheme. The employer and employee contribute 12% of the employee's basic salary and dearness allowance towards the scheme. The contributions are added to the Provident Fund account, which can be transferred from one employer to another. The employee's contribution to the EPF is eligible for tax deduction under Section 80C. Employees are allowed to withdraw funds at the time of need. The EPFO decides the annual interest rate on EPF, which is 8.1% for FY 2022-23. 2. National Pension System. The Central Government of India launched NPS to provide a regular income to individuals after retirement. This is open to government, central and state, and private employees. Indian citizens in the age group of 18 to 60 years are eligible. The interest rate offered on NPS is 9% to 12%. Employees and employers need to pay a small premium from their salary to this scheme. The contribution is 14% from government employees and 10% from other employees. The employees and employers' contribution to NPS is eligible for a tax deduction under Section 80C. At the time of retirement, the employees can withdraw a maximum of 60% of the amount tax-free. The remaining 40% will be provided every month as a pension. 3. Voluntary Provident Fund. This scheme is for employees who can opt for it voluntarily. In VPF, you need to contribute more than 12% of the salary to the PF account and the maximum contribution can be 100% of the salary. The contributions made to the VPF scheme will impact EPF and vice versa. Also, your employer will not make any contribution to this scheme. The interest rate on VPF is 8.1% per annum. 4. Atal Pension Yojana. The scheme is for individuals working in the unorganized sector who require financial assistance from the government. Individuals need to contribute a small premium and get a pension after retirement. Applicants should be of age group 18 to 40 years and have an active savings account. In the APY, the premium must be paid for a minimum of 20 years. Firstly, the applicants must set a target monthly pension they want, which will help to determine the monthly contribution they need to make for the scheme. The government will contribute only if you have no other savings scheme and are not a taxpayer. It will contribute 50% of your yearly contribution or 1000 rupees, whichever is lower. 5. Sukanya Samriddhi Yojana. This was launched by the Prime Minister of India, Narendra Modi, to secure the future of a girl child below 10 years. The SSY account can be opened at any bank or post office by the girl's parents or guardians. Per household, only 2 accounts can be opened, one for each girl child. The interest rate offered in the FY 2022-23 is 7.6% per annum. A minimum deposit of 250 rupees and a maximum of 1.5 lakh rupees per year is needed. The tenure of the SSY scheme is 21 years from the date of opening or until the girl child is getting married, aged above 18 years. This scheme allows up to 50% withdrawal of the account balance to meet the higher education expenses of the girl child account holder. The account holders can get a tax deduction under Section 80C of up to 1.5 lakh rupees per year. 6. Senior Citizens Savings Scheme. The scheme was designed for senior citizens aged 60 years or older. Even individuals who chose the Voluntary Retirement Scheme (VRS) and are between the age of 55 to 60 years can opt for SCSS. The tenure of this scheme is 5 years, where the investment can range from 1,000 rupees to 15 lakh rupees. The interest rate on SCSS is 7.4% per annum. The contributions made to this scheme are eligible for income tax deduction under Section 80C. But according to Section 80 TTB, senior citizens can claim a deduction of up to 50,000 rupees. 7. Public Provident Fund. This scheme can be opened at banks or post offices. Though the tenure of PPF is 15 years, individuals can extend it to 5 years more. It is one of the long-term tax savings schemes in India. A minimum deposit of 500 rupees and a maximum of 1.5 lakh rupees in a year is needed. The interest rate offered on PPF for FY 2022-23 is 7.10% per annum. The interest earned and the maturity proceeds are exempt from tax, and the deposited amount is eligible for tax deduction under Section 80C. 8. National Savings Certificate. This government-backed scheme offers individuals guaranteed returns and tax benefits. NSC can be applied at post offices, and the duration is 5 years. The minimum investment in this scheme is 100 rupees while there is no maximum investment limit. This scheme allows you to transfer the certificate to another person. The interest rate on NSC is 6.8% per annum, which the government decides quarterly. The contribution to NSC is eligible for tax deduction under Section 80C of the Income Tax Act. 9. Post Office Monthly Income Scheme. This is another savings scheme from the Indian Post Office. It offers a fixed income every month from the lump sum deposit made by the investor. Even minors aged 10 years or more are eligible for POMIS. The maximum investment limit for a single account is 4.5 lakh rupees, and the joint account is 9 lakh rupees. This monthly scheme offers a 6.6% interest rate per annum and the maturity period is 5 years. The investors are not allowed to withdraw the funds before 1 year from the date of opening. If the account is closed from 1 to 3 years, then 2% of the investment amount is deducted as a penalty, and if the account is closed from 3 to 5 years, then 1% of the investment amount is deducted. Both the deposit amount and the interest are tax exempted. 10. Post Office Savings Account. This can be similar to your regular savings account but can offer a slightly better interest rate. Post Office Savings Account is known for guaranteed returns and is ideal for investors with a less risky appetite. The interest rate offered on this account is 4% per annum for both individual and joint accounts. An initial deposit of 500 rupees is needed. The interest gained on this account of up to 10,000 rupees is allowed for tax exemption. 11. Post Office Recurring Deposit. This is designed for investors with small investable amounts. The Post Office Recurring Deposit Scheme starts at 100 rupees per month or multiples of 10 rupees, and there is no maximum investment amount. The maturity date is 5 years from the date of opening. It offers several benefits like maintaining joint accounts and transferring from one post office to another. The interest rate offered on this deposit account is 5.8% per annum compounded quarterly. 12. Post Office Time Deposit. This scheme from the Indian Post is famous amongst the rural population. It offers different tenures like 1 year, 2 years, 3 years and 5 years. You can open multiple deposit accounts. The interest rate on the Post Office Time Deposit Scheme is revised periodically. The current rate is 5.5% to 6.7% per annum. If the deposit duration is 5 years, you can claim a tax deduction. 13. Kisan Vikas Patra. This is a small savings certificate scheme launched in 1988 by Indian Post. As the name suggests, this scheme is particularly designed for farmers. Kisan Vikas Patra is one of the safest wealth creation options for investors with lesser risk appetite. The minimum deposit of 1000 rupees is needed, while there is no maximum deposit limit. The interest rate offered on Kisan Vikas Patra is 6.9% per annum, compounded quarterly, and the tenure is 124 months. Thanks for watching Indian Stock Hunter. Please subscribe and stay tuned for more valuable contents.